What is your initial reaction here? How does this affect your thinking about how you've been taking in the U.S. market?
Most of the downward revisions are in some of the more cyclically sensitive sectors. We're talking leisure and hospitality, manufacturing, professional and business services. So these downward revisions are mostly concentrated in a lot of, again, cyclically sensitive industries, interest rate sensitive industries, the industries that the Fed has been looking for as some sort of an indication of the resilience of the labor market. And when we see basically 818,000 jobs that folks thought had been added into the labor market actually revised out, the Fed's going to be taking note of this as we head into the September FOMC meeting.
You think about what we saw today versus what we've seen historically as well, and the number feels and looks large. It certainly is relative to what we've seen before. How was it this off? I mean, at the end of the day, $800,000, what really changes about the narrative?
So the thing that, one of the reasons why this is such a meaningful revision is because a lot of payrolls are inferred based on a relatively narrow survey of businesses. The Bureau of Labor Statistics then estimates how many jobs were actually created on the assumption that businesses are born, businesses die, they add jobs when they're born, workers get laid off when those businesses close. And that model has been pretty dramatically off. And we can see that based on bankruptcy filings. As we look at bankruptcy filings, which have been increasing, it doesn't really comport with what we've been seeing from the model operating the background of the Bureau of Labor Statistics. So we would expect the numbers to be off. This off is pretty dramatic. It's the largest that we've seen in 15, 16 years. It's about 1.5 times larger than any other downward revision that we've seen. So it's a pretty big deal.